In this video, I'll teach you what a balance sheet is, how to read one, what to look for, and things that make me worried. The balance sheet is one of the three main financial statements, the other two being the income statement and the cash flow statement. The balance sheet takes a picture of a company on a given day, usually the last day of a quarter or year. It will show you what the company owns, called assets, the money owed to lenders, called liabilities, and the money owed to shareholders, called equity. It's called a balance sheet because it must balance. But what must balance? What the company owns, its assets, must be equal to what it owes, its liabilities and equity. If it doesn't, your balance sheet is broken. The balance sheet is set out in order of liquidity. Liquidity means how easily it can be turned into cash. The easier something can be turned into cash, the more liquid it is. Take assets for example. We have two main types of assets, current assets and non-current assets. Current assets are things which can be turned into cash within the next 12 months. That includes things such as cash, marketable securities, and inventory. Non-current assets are things which are not expected to be turned into cash within the next 12 months. That includes things such as property, plant and equipment, and long-term investments. We also have two main types of liabilities, current liabilities and non-current liabilities. Current liabilities are expected to be paid off within the next 12 months, things such as short-term debt and accounts payable. Non-current liabilities are not expected to be paid off within the next 12 months, things such as long-term debt and long-term leases. A single balance sheet can tell you a lot about a business, but even more insights can be gained by looking at a series of balance sheets such as the last 10 years. Websites such as ROIC.ai can save you time. When reading a balance sheet, I look at the following metrics: equity, current ratio, debt to equity, and debt to EBITDA. As a shareholder, I want the money that is owed to me, the equity, to grow. If the equity is growing, it's likely the value of my investment is growing too. Take Chipotle for example. In 2013, total equity was $1.538 billion, and in 2023, it was $3.062 billion. That's a 10-year compounded annual growth rate of 7%. In 2013, Chipotle's share price was around $6, and in 2023, it was around $38.80. That's a 10-year compounded annual growth rate of around 23%. The current ratio tells you if a company can meet its short-term obligations. That means it can pay its current liabilities. A current ratio of less than 1 means the company might not be able to meet its short-term obligations. ROIC.ai calculates the current ratio for us. If you want to calculate it yourself, you divide current assets by current liabilities. In 2023, Chipotle had a current ratio of 1.57. That means for every $1 in current liabilities, Chipotle had $1.57 in current assets. This indicates Chipotle can meet its short-term obligations. Debt can speed up growth, but it also adds risk. The debt-to-equity ratio can help us determine if a company has too much debt. To calculate it, we divide total debt by equity. In 2023, Chipotle had short-term debt of $0.248 billion and long-term debt of $3.804 billion. This gives us a total debt of $4.052 billion. Total equity was $3.062 billion. That gives us a debt to equity of 1.32. That means for every $1 of equity, Chipotle has $1.32 in debt. A good debt to equity ratio will depend on your risk tolerance. Some people like debt to equities of less than 0.5, meaning the company has twice as much equity as debt. Others like a debt to equity of less than 1, meaning debt is not greater than equity. A debt to equity of 1.32 could indicate Chipotle has a high amount of debt. Having a high debt to equity does not necessarily mean the stock is risky. We should also see if the company has the cash flows to repay its debt. To do this, we can calculate the debt to EBITDA. EBITDA is short for earnings before interest, taxes, depreciation, and amortization. It's a simple way to get an estimate of a company's cash flows which the company can use to pay off its debt. To calculate debt to EBITDA, we divide total debt by EBITDA. In 2023, Chipotle had total debt of $4.052 billion and EBITDA of $1.953 billion. This gives us a total debt to EBITDA of around 2 times. Given Chipotle's 2023 numbers, it could pay off its debt within 2 years. As a rule of thumb, total debt to EBITDA greater than 4 could indicate a risky stock. A note on risk. Risk doesn't mean a company is a bad investment. You just need to make sure you are being compensated for taking on that risk. If a stock looks risky, you should demand a higher return. You do that by paying a lower price. Let's summarize. The balance sheet tells you what a company owns to lenders, and owes to shareholders. Items are listed in order of their liquidity. Generally, I look for companies with growing equity, a current ratio greater than 1, debt to equity less than 1, and total debt to EBITDA of less than 4. For more videos on investing, follow value theory or go to valueinvestoracademy.com.